They told you bonds are safe. But if that were true, why are the richest people on the planet dumping them? Why are central banks hoarding gold? And why are countries like China and Japan refusing to buy U.S. treasuries? It's because the truth about safe investments is finally coming out. It's not pretty. Welcome to the Passive Path, where we break down what really builds wealth, not what financial planners want you to believe. Let's start here. Most people think bonds are the backbone of a balanced portfolio. They're told bonds are safe. They're told bonds protect you when stocks crash. They're told that U.S. treasuries are as good as cash. But none of that is holding up anymore. And deep down, you probably feel it too. Your money doesn't go as far. Your savings feel less secure. And the people who once called bonds safe have quietly moved their own money elsewhere. So what changed everything? Governments are drowning in debt. Pensions are underfunded. Interest rates are rising. And more countries are rejecting U.S. bonds as a store of value. Let me ask you, if a bond is a loan and no one wants to lend to the U.S. anymore, how safe is it really? And if you're holding those bonds in your pension, 401 or ETF, what happens when the bond market breaks? We'll get to that in a moment. But first, let's step back and talk about the lie you were sold. The lie of safe investments. Think about how financial advice is usually delivered. Invest for the long term. Diversify across stocks and bonds. Don't try to time the market. Sound familiar? It's the same script, but here's the problem. This advice assumes the system itself is stable. What if it's not? What if the real risk isn't volatility, but currency collapse? What if the safe assets in your retirement account are quietly losing value every single day? That's not a theory. It's already happening. Take a look at the U.S. national debt. We're not just running trillion-dollar deficits each year. We're sitting on over $100 trillion in off-the-books liabilities, pensions, healthcare promises, military benefits. There's no plan to pay for any of it. So what will the government do? They'll print. And when they print, the dollars you hold, bonds you rely on, and the savings you've built all lose value. And this brings us to the bond market. Why bonds are the new risk? A bond is a loan. When you buy a bond, you're lending money, usually to a government. You expect to be paid back with interest. Sounds simple, but the only thing that backs a bond is the borrower's ability to pay. And right now, that borrower is broke. The U.S. debt clock is spinning out of control. Interest on the debt is now one of the largest budget items in the federal government. At some point, it becomes impossible to keep up. That's not a conspiracy, it's math. So if bonds depend on a country's credit, and that credit is collapsing, then bonds aren't safe. They're toxic, and central banks know it. That's why countries like China, Japan, and even U.S. allies are ditching bonds and stockpiling gold. The shift to real money in 2019, the Bank for International Settlements, the central bank of central banks made a quiet change. They reclassified physical gold as a Tier 1 asset. That means gold is now treated the same as cash or government bonds on a bank's balance sheet. That wasn't random. It was a warning shot. Banks no longer trust the bond market. They're moving to real money. Gold, silver, and even Bitcoin. The world is slowly waking up to the truth. Paper wealth is fragile, and when systems break, only real assets survive. So here's the question for you. If the world's most powerful institutions are ditching bonds for gold, what are you still holding? And why? Let's get real on the passive path. We don't chase hype. We study what the rich are actually doing. Here's what they're doing. Dumping bonds. Hoarding physical gold. Buying up lithium, copper, and silver. Diversifying out of fiat currencies. Investing in real businesses that solve real problems. They're not buying ETFs and hoping for the best. They're meeting founders. Visiting mines. Evaluating risk based on reality. not Wall Street models. And they're doing this because they know we are entering a new era. The old 60/40ths portfolio doesn't work anymore. Your balanced retirement fund is at risk. And the worst part? Most financial advisors won't tell you this because they don't know either. That's why it's on you to learn. So what happens next? The next section, we'll break down exactly what's happening to the bond market and why it's 10 times more dangerous than the stock market crash everyone's been talking about. Because when the bond market breaks, everything else follows. Like this video so far, then hit the like button, subscribe to The Passive Path, and drop a comment below with what you're holding: bonds, gold, crypto, or something else. Let's keep going. The bond market is the biggest market in the world. It's larger than the stock market by a factor of 10, yet almost no one understands how it works, and even fewer realize how dangerous it's become. For decades, U.S. bonds were treated like sacred instruments. Governments bought them, banks held them, pensions depended on them. They were called risk-free assets. But that story's collapsing. And if you're holding bonds through your retirement fund, ETF, or index portfolio, this affects you directly. Let's start with the basics. A bond is a loan. The buyer of the bond lends money to the issuer, usually a government. In exchange, the issuer promises to pay back the loan plus interest. That interest is called the yield. The longer the maturity, the greater the risk, and usually the higher the yield. Now here's the problem. When inflation rises faster than the bond yield, the bond loses real value. Let's say your bond yields 3%. If inflation is 6%, you're losing 3% a year. On paper, you're earning. You're bleeding. This is what's happening across millions of retirement accounts. People are told their money is growing, but when adjusted for purchasing power, they're falling behind. And here's where it gets worse. The United States is issuing more debt than ever. Each year, the Treasury sells trillions of dollars in new bonds, but the demand is drying up. China and Japan, once the biggest buyers, are stepping back. So who buys the debt? The Federal Reserve. When the Fed buys bonds, it doesn't do it with savings. It creates money out of thin air. That increases the money supply, and that drives inflation. So now we have a cycle. The government borrows more. The Fed prints more. The value of the dollar drops, and the bonds you hold become less valuable. This is not a future risk. It's already happening. Look at the numbers. The interest on U.S. debt is over $1 trillion per year. That's more than the defense budget. It's more than Social Security. At some point, the government will have to choose: cut spending or print more money. History tells us what happens. They print, and bonds collapse. Now think about what that means for your portfolio. If you hold a bond ETF, it's filled with debt instruments that are falling in value. If your pension fund relies on treasury yields, it's falling short. And if your entire retirement plan is based on the idea that bonds will be stable, you're in trouble. Meanwhile, the people managing large money, they're moving on. They're not holding long-dated treasuries. They're buying commodities. They're moving into hard assets. And they're reducing exposure to dollar-denominated debt. Even the central banks are doing it. Over 70% of the gold purchased in recent years came from central banks. They're getting out of U.S. bonds. And they're not making speeches about it. They're acting quietly, but the numbers are public. The message is clear. The bond market is no longer safe. And when it crashes, it won't be a small event. It will ripple through pensions, banks, insurance companies, and mutual funds. And most people won't see it coming. They'll be told it's a temporary correction, that it's under control, till it isn't. This is why you need to rethink what safe means. Real safety isn't a promise on a piece of paper. It's owning something real. And that's exactly where we're headed next. The old rules don't work anymore. Bonds aren't safe. The dollar is losing trust, and real assets are taking center stage. This is a turning point in financial history. You can either follow the same advice that's failing millions, Or start building wealth the way the rich do, with knowledge, with ownership, and with real assets. At the Passive Path, we believe in practical education, not hype, not fear, just clarity. Start asking better questions. Start digging into the truth behind your portfolio. And start thinking like an entrepreneur, not just a saver. If you found this video helpful, like it. If you want more insights like this, subscribe to the channel. If you have thoughts or questions, drop them in the comments below. I read every one. If you know someone who needs to hear this, share it with them now. This knowledge can change lives. Good luck on your journey. Feel free to watch other videos here on the Passive Path to keep learning and growing. And I'll see you in the next video.